Okay, something just happened that pretty much changes everything for the markets. And honestly, most people totally missed it. The Federal Reserve. They just pulled a massive liquidity trigger. So let's get right into it.
So, you're probably wondering, what was this huge move? Well, at the very beginning of December, the Fed quietly, almost silently, ended a policy that has been draining money from the entire system for years now. But here's the thing, ending this policy wasn't the finish line. Nope, it was the starting gun for the next big wave.
You see, it all comes down to an unseen trigger that was just pulled, and it has a name: Quantitative Tightening, or QT for short.
That's right. On December 1st, the Fed officially slammed the brakes on QT. For months and months, they'd been shrinking their massive balance sheet. But on that day, the runoff, it just stopped. Cold.
So what even is QT?
Well, to put it simply, it's the Fed sucking money out of the financial system. They do it by selling off assets they bought during all that stimulus. It's kind of like a giant vacuum cleaner for liquidity.
And the scale of this thing is just mind-boggling. Since 2022, the Fed has drained about $2.2 trillion in liquidity. I mean, think about that. That is a massive, massive amount of money to just pull out of the system.
And this is the most crucial point to understand. Ending QT isn't just about stopping the tightening. It's the trigger that forces the Fed's hand, and it sets up the next major phase for all the markets. And you know what? We've seen this exact movie before.
But hold on, why did they stop? Well, it's because deep inside the financial system, the really critical plumbing was starting to crack under all that pressure.
It's actually a pretty simple chain reaction. You see, as the Fed kept draining liquidity, the cash reserves held by banks started getting really scarce. And that put a huge strain on the overnight lending markets, the essential plumbing of the financial world. And that's what forced the Fed to step in.
The biggest warning sign came from something called the Standing Repo Facility, or SRF. Just think of it as the Fed's emergency cash window for banks, right? When banks can't get cash from each other, they run to the SRF. And back in November, they started running there a lot.
And what's really telling is the speed of it. I mean, we saw usage jump from 15 billion to 20 billion and then up to 24 billion in just a few days. We haven't seen numbers like that since the COVID panic. This was the system literally flashing a bright red warning light.
And this wasn't some big secret. Fed officials were watching this happen in real time. Lori Logan, the Dallas Fed president, she actually said it out loud: if this stress continues, the Fed will have to start buying assets again. They knew. They knew the system was at its absolute limit.
So what happens next? Well, the good news is we don't really have to guess. We have a very clear historical playbook from the last time this exact scenario played out, and that was back in 2019.
Just look at this sequence. In August 2019, the Fed ended QT. 1 month later, boom, the repo market blew out. By October, the Fed was forced to start buying assets again. They tried to call it not QE, but guess what? The market didn't care one bit. And the result was a massive rally in risk assets right into early 2020.
Seriously, just look at these numbers. The second the Fed flipped from draining liquidity to adding it, everything took off. The S&P 500 jumped over 18%, the tech-heavy Nasdaq soared over 27%, and Bitcoin went on a blistering 200% run in just a few short months. Different assets, different returns, but all powered by the exact same driver: fresh liquidity.
By the way, if you're finding all this valuable, it would be awesome if you could take a second to like, share, and subscribe. That way you won't miss what's coming next.
Okay, so the 2019 playbook, it's not just history, right? It's basically a roadmap for what analysts are expecting is coming next, and it's setting the stage for another major liquidity wave.
And listen to this. The Fed isn't even being shy about it. The chairman, Jerome Powell, and the New York Fed president, John Williams, have both said in pretty clear terms that the balance sheet will have to start growing again. They're basically telling you what the next step is.
Now, this is a really critical distinction to make. They are not doing this because the economy is weak. They're doing this because the financial system's plumbing is breaking. It's a technical fix to keep the whole system stable. And yep, the forecasts are already starting to roll in. Major analysts like Evercore and the Financial Times are already projecting that the Fed will need to start buying tens of billions of dollars in assets every single month, possibly starting as early as 2026. The direction of travel here is crystal clear. Okay, but every thesis has to have a risk, right? There's one major variable that could change this entire outlook, something we could call a gray swan.
So, a gray swan isn't a total shock out of nowhere like a black swan. It's a known risk. It's something we can actually see forming on the horizon, even if we think, nah, it's probably not going to happen.
So what is the big risk here? It's not inflation. It's not a bad jobs report. The single biggest threat that could completely derail this entire liquidity playbook is the rising level of domestic political instability. That is the ultimate wildcard that could change everything.
Okay, so let's bring it all home. The real takeaway is this. The Fed is essentially trapped. They can't shrink their balance sheet anymore without breaking the system. And that means the long-term direction is pretty much set. More liquidity. And historically speaking, that kind of environment overwhelmingly favors people who own assets over those who just save cash.
The pattern from 2019 gives us a really clear roadmap for what happens when the Fed pivots from tightening to easing. And right now, all the signs are pointing in that exact same direction. So the only real question left is, will history repeat itself?